Fibonacci. Using Fibonacci numerical sequence in your trading, I believe that based on my application of and use of the Fibonacci tool, I believe that Fibonacci is probably one of the most versatile tools to effectively trade in almost any market, and particularly in the foreign exchange market, because it is so efficient and so fluid and so liquid, that Fibonacci is very effective in trading both intraday on the smaller time frames, as well as trading in the long term, trading off of the daily charts and analyzing off of the daily charts, daily 4-hour, 2-hour, 1-hour, 15-minute, although I'm less inclined to use it on the smaller time frames. But my point is that Fibonacci is just a very, very versatile and useful tool regardless of what market it is that you trade. A little bit about the background on Fibonacci. It comes from Leonardo Fibonacci. He was an Italian mathematician from 1175 to 1250. He is considered the father of mathematics and best known for the Fibonacci sequence of numbers. Fibonacci sequence of numbers is actually quite simple. Sure, it seems simple after the fact. One number is the sum of the previous two. So 1 plus 2 equals 3. 2 plus 3 is 5. 3 plus 5 is 8, and so on, all the way into infinity. Now, I'm not going to get into the square root and divisions of the numbers and how our retracement and extension numbers have been developed or been determined. That's something that you can do research on the internet, because we really want to learn how to trade here, don't we? And we want to understand the application of the tools. But certainly you're free to do internet searches on Fibonacci, and you'll find out so much information on Fibonacci. And actually, if you're just a curious type and you'll just like to learn about various things, if you go in and you do some study on Fibonacci, you will see how amazing the Fibonacci numbers are and how they exist in the world around us. The Fibonacci number also is also the golden ratio is a Fibonacci number, also known as the divine proportion or the golden mean or golden section. And it's a number often encountered when taking the ratios of different distances and simple geometric figures such as the pentagram, decagon, and dodecagon. But again, you can do that homework on your own in your spare time. Here we're going to remain focused on trading. Fibonacci in our lives. If you simply browse the web for more information on Fibonacci, you'll see how Fibonacci numbers are existent in the financial markets as well as in nature around us, and how our bodies are constructed and formed in a ratio that is consistent with the Fibonacci numbers. As well, we see Fibonacci numbers around us in the universe. Before we begin to apply the Fibonacci numerical sequence and the Fibonacci retracement extensions on our charts, it is important to distinguish price swings and to distinguish up price swings where price is making higher highs and higher lows, down price swings when price is making lower highs and lower lows, as well in sideways markets, because we may find a consolidation within a trend. And remember, there are trends inside of trends. There are consolidations inside of trends, up trends and down trends. And your application of the Fibonacci tool will be more effective the greater you understand and are able to see upswings and downswings and consolidations on the charts. You'll be able to more effectively apply the Fibonacci tools. When looking at the technical on a chart, we want to be able to see the price swings. Of course, here we see an uptrend, prices making higher highs and higher lows in an uptrend. And here's what it looks like on a chart. Of course, when we look at a slide like this is nice and smooth and clean, but when we look at a chart, it can sometimes be a little bit confusing. And you may ask yourself, well, where is the price swing? Which price swing is the important price swing? Well, that gets back to our lesson on support and resistance and finding the very distinct lows and the distinct highs and making the connection between them to determine our price swings. Here we see prices making higher highs and higher lows. Sometimes we have these consolidations that can confuse us, but price makes a marginally higher high, marginally higher low, and then the trend continues. The trend slows here, but still we have a marginally higher high, marginally higher low, and then we see how price here makes a lower low, but continues to make a higher high. We have small price swings inside of larger price swings, and the best way to learn this is simply by looking at charts and pulling your Fibonacci's on the various time frames. Here we're looking at a 60-minute time frame, and we want to get you accustomed to looking at and analyzing all of the various time frames and understanding its importance in the relative spectrum of all of the time frames. So here we give it a little bit of a cleaner look, showing the price swings and the market making higher highs and higher lows in a series of up price swings. Now here we have a downtrend where the market is making lower highs and the market is making lower lows. If we were to magnify this onto a smaller time frame, then we would see more distinct price swings on a 15-minute chart. But on this 60-minute chart, it is a very, again, it's one of my favorite charts to look at to get just a general idea of what's happening in the market, and it gives us a very clean look at what's happening in an interim level. Market making lower highs and lower lows. And here you can see how I've just simply drawn the points of the swings from the lows to the highs to give you a better visual of the market making lower highs and lower lows in this downtrend. Well, what do you see here in this chart? The last chart was somewhat of a simplistic view, but I want you to see there's one more thing that I want you to see here. Naturally, as we discussed in the support and resistance level, you see how we see a series of ranges as price continues to move lower, making lower highs and lower lows in these ranges. But again, we see a series of dealing ranges. We see price making lower highs and lower lows, higher highs and higher lows, lower highs and lower lows. Well, let's break this down. Here are our somewhat distinct price swings for the series, but if we step back and look at the bigger picture here, what we see is we see one large price swing with a multitude of smaller price swings. We see small price swings making up this downtrend, small price swings making up the uptrend, and then of course smaller price swings are the constituents of the new downswing. We're in an overall downtrend, yet we still have price swings moving up and a rally in the overall downswing. Again, now here we're looking at a 4-hour chart, so it covers more time, and we're able to see these distinctions in the market over a larger time span. Many tradable scenarios in this upswing if we were to look at our smaller time frame, but overall we're in a downtrend, continuing the down price swings. price is constantly moving up, down, or sideways. It predominantly moves sideways in its ranges, as we clarified in the support resistance section. But here we have an uptrend, followed by a downtrend, followed by an uptrend. But if we were to step back and look at this, we see one overall price swing over the longer time frame. The market moves in a Fibonacci numerical ratio. Take this uptrend, for example. In general, what we're looking at is we're looking at price retracing 62% and extending 162%, retracing 62% and extending 162%. Now what this means is that if this price swing is 100, the market here will retrace 62% of this overall price swing. We're obviously not to scale. I'm not an artist by any means, but let's just assume that this retracement comes back 62%. Then it will extend 162%, so it will extend 100% plus 62% of this retracement level. And we're going to look at this more closely if you find this confusing. So what we're seeing here is we're seeing a rhythmical pattern of extensions, of retracements, and extension values. Taking out all of the mathematics that establish where these numbers come from, which is some homework you can do on your own, the primary values that we're looking at are these: retracement levels of 38%, 50%, 62%, and 79%. The extension values that we're going to look at are the 127%, 162%, and the 262% extensions. Now we will break this down a little further. If we have a price swing that starts here at this low and price moves up, we have a full price move from the low to the high. Then, as we saw in our previous examples of price swings, and as we've seen many examples of leading up to this point, we will then watch price retrace, and it could retrace 38%, 50%, 62%, 79%, or it could retrace a full 100% of this rally. So these retracement values are the retracement percentage of this price swing. So if this price swing represents 100, here we've retraced 38%, 50, 62, 79, or 100. In this example, price turns at 62% and rallies above the high. Then price is now extending above the high. Then we reach 127%, where we often see price exhaustion. Typically doesn't hit it right on, it typically just exhausts in that general area. Often we will see price retrace back, and what you should look for, of course, is this characteristic, which we've seen many examples of. This level of resistance becomes support, and price may continue up 162% of the original price swing. And again, these extension levels are more exhaustion levels for the market. And that is 162% of this being 100 plus 62% is 162% extension.